Good afternoon, everybody. I'm Dan Hussey from Zaner Ag Hedge, bringing you a strategy of the week update here. We are going live on Facebook this week. Be sure to sign up in the comment section and the information section of this video for our weekly strategy of the week update here every 2 p.m. on Thursdays, or do sign up for our strategy or our daily newsletter there from our Zaner Ag Hedge team. Both links available in the comment section and information section of this video. Again, I'm Dan Hussey from Zaner Ag Hedge. Welcome to the Strategy of the Week webinar. It is Thursday, October 6th today. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We're going to begin today, I think here just with the dollar index. We're going to start with corn, but let's begin elsewhere, because the dollar here, big rally back above that 18-day moving average, coming out from that oversold daily RSI in the dollar index and remaining well above that 110 figure. Market pulled back, tested support, now is resistance, or other way around, resistance now is support, right? It was 110, kind of broke out of that level, came back down to test the support. 100-day moving average is well below us at 106. 50. The 200 days way down there at 102 and change. And that 18-day moving average right around 111 is the supportive area and trend kind of level, that bullish above, bearish below in the near term. The dollar has had a substantial rally, and I think without any kind of taper or change in Fed speak, we're going to continue to see this strengthening of the US dollar. Now, I shouldn't just say that, because there is, of course, always the other side of the coin in currencies, which is, if we're not talking about dollars, we're talking about whatever cross currency, you're exchanging dollars for. Because we're not talking about the dollar in terms of inflationary standpoints against a basket of currencies. That's a whole nother discussion. But against the other baskets of commodities, not currencies. The dollar against the basket of commodities here is still in a clear uptrend. Dollar strengthening. It's the strongest among the fiat, and there seems to be still flight to quality into the dollar. We can see that from the sell-off that we are witnessing here occur. Hopefully I've got a 30-year chart on this. I do. Here we go. Wait for some of this data to load here, but the sell-off that we're seeing in the 30-year bonds here is going to continue to drive dollar strength, because there's essentially the notion that U.S. dollar strength is coming from the positive carry that our currency is now deriving, right? With a higher than average, or I guess higher than the rest of the world, relatively speaking, interest rate now, the U.S. dollar becomes a very, very demanded and sought after asset, and that those U.S. dollars that come out of banknotes, bonds and 10 years. That are produced in interest with those currencies, allow people, right, to borrow money where it's cheaper, where you pay less in interest rates, like maybe Japan, for example, where interest rates are still extremely low. You can turn those yen, where you borrowed yen, and turn that yen into U.S. dollars, and turn around and sell those U.S. dollars on the open market, or not sell those U.S. dollars, lend those U.S. dollars out in the U.S. And that's resulted in a really, really strong up move here for the last 2 years in the dollar relative to the yen. That positive carry, big driving factor. If you flip this dollar yen chart upside down, it looks just like our a 10-year chart. And there's a notion here that as the U.S. dollar continues to strengthen, we're going to continue to see it become better bid across the world. And certainly while the Fed is in a rate rising environment, that's going to be some trade winds that are moving against the broader economy here in terms of our export markets and for many of these commodity prices. All right, so let's hop into commodities. The dollar's strong. It hasn't backed off. It's strengthening, yet U.S. rates still continue to seem to be going higher, at least in the futures and what we're seeing in Fed funds in the 30-year. There is that risk on, risk off notion in the market still at play. The S&P 500 and the Dow and our equity indices still seem to be caught in a bit of a downtrend. The resistance we just found on the S&P here into the 3,800 area is also coming in on some potential channel resistance here. But we definitely have, I think, if you're an Elliott waiver, why won't my channel stick? There you go. If you're an Elliott waiver, this looks a lot like a 5-wave sequence is trying to play out. Obviously, the market would need to break below today's low and yesterday's low to really accelerate, back down to the lows of the month. But the full 50% retracement, from our 2,100 lows from our, when I go back and talk about that Millennial Black Monday during COVID, where the market and the whole world seemed to be falling apart, from that low to the highs thereafter, a full 50% retracement is around 3,500. So, testing down to that level is not out of the question. We were also still holding this full 50% short from the 4,800 area. Not us, but the market is holding, right? Up here at around 4,300. It's not like a trade that we were taking actively in this room, but certainly we, talked about it, thought about it, looked at it, and have downside targets from a technical perspective down around the 3,300 area. So, yeah, I don't believe this 2-day rally in the S&P is anything but, at this point, a dead cat bounce. Not even back above 3,900. Couldn't even get there to test kind of this old broken, supportive area, from the end of August into early September, around 38.80 down to 38.40. It broke below it here and haven't even really broken back above it or even tested it for more than a half a day or so here at 3,800. So rolling back over on the S&P while we're below 3,800, certainly below 3,900 in the near term. I think we got downside potential here in a risk-off move still, and that really makes me cautious about some of these uptrends we've seen in the very near term, like crude oil. By all means, I think we are possibly forming a low in crude here. This looks like a really decent rally so far. Again, a little bit of an uptrend here in a channel so far. Breaking and trying to break above trendline resistances against the highs. Lots of them that you can draw up here. We've already broken through one of the more aggressive ones that was all the way down here at 85. Now we're coming up into this inflection zone where we found support there in August and into September. Tested its resistance again in September, coming back up here now in October to test it. I want to point out on the chart that, hey, we might end up with a little bit of an inverted head and shoulders pattern, something to watch for here on crude. That would put a 90 neckline on it. You got a left shoulder here forming. The head is down here at 76.25. And if we were to see a pullback down to 82 to 80, down towards lows of the month, maybe test around there, that would be the right shoulder forming of this inverted head and shoulders pattern. Back above 90 after a pullback. Again, we need to form that right shoulder for this type of technical setup to present itself. But again, that's why we're watching these footprints in the sand. We're trying to figure out what's happening before it gets there so that we're not, caught off guard or we're ready to do something with it. But the 90 figure, right, a breakthrough there pretty much opens the door. I think, just from any perspective here, even in the short term, opens the door towards, the 96 highs that we saw before. And again, that area on the chart, another big important inflection zone that we spent some time chewing through on the way back down here in June and July. We thought we might hold it. We went below, resistance, and then, lower. So big area to chew through here from 90 to 96. Back above that threshold, we're obviously opening the door back up to 100. And in my opinion, this channel that we see lower might take us up towards 110 to 115. And then again, above those levels, now you're talking about a breakout towards that 160 to maybe 146 to 160 new highs and a massive swing higher. All in the near term, however, crude has maintained a pretty solid uptrend here in the near term. I'm watching down upward sloping trend lines at this point. Against the lows here, they're pretty aggressive. The full 50% retracement of this rally would take you down into 82, but watch out here because we have a little bit of an open gap on the crude chart down here at 80. I took off the continuation chart here, just looked at the raw November, so we all got an idea of where November crude has an open gap below us. And so going down to test the lows of the month, and filling that gap, setting up that head and shoulders pattern. That could all be in the works here for the crude in the near term. Now, again, we could just continue to rally away from that level, leave it open, and say la vie. But I've never known a commodity market to go in a straight line forever. So I am anticipating, a nice solid $4 to $5 pullback of some, degree, the type of move that makes you feel like crude is over, before I'm, stepping in to be a buyer at this time. Now, I'm also very worried about the idea of going long crude if we are in fact in a risk-off environment here in the S&P and in other charts, because in other markets, because obviously that could cause, that contagion fear selling that often comes alongside a big economic slowdown, or in this case, a risk-off move that we might be seeing in the S&P. And of course, all of that coming around the Credit Suisse contagion that we're worried about now. Lots of people talking about how this is the next Lehman Brothers type event, yada yada. Might be the case, but let's not forget we're talking about the smallest country in Europe right now, and one of their major banks. So when you put it into perspective, not exactly the same magnitude, and it's also not a U.S. bank. So I'm not actually worried about it. I know the CDS spikes, okay, just means Credit Suisse is probably going to go up in flames, but I've seen no evidence that any banks are choking for cash right now. If anything, they're choking on their cash, or hungry for cash. They're choking on it. They've got too much of it in the coffers, and that's a problem because they almost don't know what to do with it. Well, financial crises like this give them plenty of reason to spend it, and that oftentimes results in more inflation. All right, so we're going to look at the October lean hogs real quick and then switch ourselves over to that December chart, because goodbye October, hello December. And at this point in time, the hogs, I think, have set up in a nice downtrend. Okay, we had a gap up today here on this December hog chart. Obviously, we'd be looking for that gap to fill. But the move higher now that we're seeing, it's a real question of how high, in my opinion, can this market go. The full 50% retracement off of the 91 high down to the 72.80 lows comes in around 82. It's also the inflection zone where we held support for, almost 6 months. Here from February through August. We broke back below this 80 to 82 area, and that calls into question pretty much why I'm looking to be a seller on a move up to 82 here in the near term. I think it would be good in many ways to see this market tag that high for the month and then go up into 50% retracements and this and this inflection zone, roll back over and start the leg lower that ultimately we'll be looking for. So over the next couple days, I'll be looking for that move up in the lean hogs. There's a couple ways to maybe capture that. Could be looking at maybe $76 to $70 puts, but in essence here, it's a pretty defined risk reward type of idea where, selling a rally up into the 82 area stops above 85. I am cautious about this open gap we have here on the December chart. I've got it put around here at 85.67 area. We'll be watching that level closely because gaps like to fill, right? But we've got an open gap above us and below us now on the lean hogs, which these two little green lines denote for us. And we'll be watching those two levels closely. But again, a rally up into that inflection zone and failing to fill that gap and rolling back over, and then maybe at that point coming down to fill this 76 gap, certainly a bearish development that we're going to continue to monitor. Now, that doesn't, of course, mean it's 100% has to go down, but you guys know the drill. This is all about risk reward. There's no certainties in trading. Live cattle, I guess I got to flip these charts over to the December contract here for the live cattle, and then switch over here to November for our feeders. Not that you have to just yet, but on the feeders, but it makes sense given what we're seeing here lately. And let me take a moment to do that over here on our other charts. And let's look at some moving averages here for our cattle. We'll get into our row crops, which we finally have some good discussions that need to be had. Because it has been very, very, very dry the last several weeks. There has been almost nothing to talk about for our row crops because, or I guess it's really, I've just been a broken record, right? It's just been the same discussion over and over and over again. All right, so December live cattle. Come on. There we go. All right, so December live cattle, 100-day moving average and 200-day moving average on top of each other, right where the market is now finding resistance. Obviously, that 18-day moving average has rolled over, crossed below the 55-day moving average. So that's one of those, kind of first signs that a bear market might be underway. And then we need to now see the market roll back over, and of course, head down to lows and drag those moving averages lower with it. 18-day moving average at 148.89. Certainly going to be resistance here within a day if it hasn't already, been thought of it as. We're in the middle of both, the range since last May, as well as, the RSI reading right now. It's the stochastic RSI. So it leads me to believe that there's still plenty of room for live cattle down to 143 to 142. We're not oversold. We're just starting to test below some moving averages, and we're holding below the 55 and 18 day, and a little bit of a downtrend's intact. So we'll see if that rolling over continues to, play out. But I think live cattle has traded up into resistance here. I like being a seller, into the 148 to 149 area up here. I don't want to see the market get above 150. And of course, I think downside, we could see the market, still head a little lower, just in the range that we've been in for the last several months. I mean, this isn't, I'm not trying to hit a home run here. We're just trying to figure out the ebb and flow of the market. Feeder cattle, on the other hand, in that November contract are back down to the low end of the range that they've been in for the last several months, and last year, really. The 18-day moving average is now coming in as resistance. It's at 178.79 now. But inside price action here for the last couple of days. Yesterday was an outside day and a bullish engulfing candle against the prior 2 days. But then today's candle just sold right back off into that range. So it kind of negates any of that, hope that we might be having, an explosive reversal. The fact that both feeders and fats rolled over and have hogs to some extent, when you take a step back and see where hogs have been, right? They've really rolled over. But that feeder cattle chart failing to get any follow through here yesterday from yesterday's price action, and it's still certainly in the range we've been in for the last week, leads me to believe there might be now continuation lower. And I think over into the end of this week and into next week, we're going to see that. So the trend train, I think, is still lower for the feeder cattle. Fat cattle could be following suit. And actually, I mean, for all intents and purposes, fat cattle have more of a setup to be a seller from right here than feeders. But nevertheless, we'll see how those two behave in the near term. All right, moving on to our December corn, holding up like a champion. I mean, you almost got a slow clap for corn these days because both wheat and beans have kind of rolled over in the near term. Today was a double-digit down day for both of those markets, and yet here's corn still hanging out around 680 in December. You just can't ask for a better harvest time frame market. I mean, it's just not budging right now. That concerns me because the longer it stays up here, really without breaking above $7, because we've spent the last 3 weeks now, pretty much, I'd say since, the end of August, trying to break through 7. This is solid. 1, 2, 3 solid attempts to get above $7 here in the last 2 weeks, and it just hasn't. And if a market can't go up and it just stops going up. There's only one other direction it can go, which is down. And the 18-day moving average that we kind of were holding in a short-term uptrend here, we then started to go into consolidation mode and have been once we came back below it, we just been unable to really stay above it. And but the only other, I guess, silver lining here is that all the other moving averages are below us, and that 100-day moving average now at 660 seems to be the short-term support. So below 660, I think opens the door to a test of 640, and the 100 and the 55 and 200 moving averages down around there. But ultimately, also a test of these old highs we were holding into the end of August that were resistance, now support, potentially on a pullback. Just went into our, oversold territory on the daily RSI. That to me is a bit more of a bear signal because we're, it's going negative or going red when the market's turning over and going red for the first time, which leads me to believe there's going to be maybe another day or so of selling at least, and certainly potentially a retest of 660. It seems like in the near term for December corn. On the smaller time frame chart here. Four-hour chart for December corn. Do have an alert up there if we go below 660. It's been an important level I've been watching the last few days. Okay, everything about this chart remains the same. Basically from what we were talking about last week. The only difference is now we've got these upward sloping trend lines that are starting to maybe break or kind of be pressed. What did I just... Apologies, everyone. Pull up those charts again. Okay, so December corn 730.52 upside potential target. I'm sorry, upside open gap. Two open gaps below is down at 630 and 584. That would be an upside target if we break through 7. That's very logical next place to go. But at this point in time, above 7 bullish, below 660 I'm bearish. We've got a 40-cent range that we've been in for the last week or so that I think is going to dictate the way we come out of this range. And that doesn't mean we couldn't have a head fake in either direction by all means. But back below 660 opens the door down into the full 50% longs, which just got highlighted blue there. That's just from the 561 low to high. That comes in around 630. That open gap at 628 too. This trader has a hunch we're going to be heading back down to that level. If we hold from there and head higher, great, but I'm fearful that if we roll over from here, we could see a test of $6 or fill this open gap down around 584. Can't rule out at that point a move, lower towards 550 to 520, but that's a long ways off, right? In the near term, we are in a 40-cent range at highs. We've got a little bit of, we actually, if you're following, the trend pattern here, see this 50% line from highs to highs. It was an old setup, same anchor, new high that traded 6218 lines. The second it did, and it rallied up into its new high, or up to 694, I should say, after. So it's from 662 to 664. That broke a 50% trend line or fib off the highs. And whenever that type of double break occurs, I start to look for wedges that form in the market, or you should cue yourself to start drawing up those trend lines above support and above support and below support and above resistance, and you start to see that consolidation and triangle type of structure forming. That type of triangle structure is very prominent on the or sideways structure, I should say, at the very least, and certainly was more prevalent on the beans until more recently. You can kind of see it here as we were tracking it earlier this year. And we'll get into this price action in just a minute. So let's move on to soybeans. But just to wrap up corn, I'm bullish above, bearish below the 660 area. Certainly a lot more bullish above $7. But I am concerned now and kind of starting to flip my hat. Any kind of long position I have on, I'm looking to buy puts, sell calls against. To try to get some kind of protection on. And literally buying puts and selling calls with a long future is a strategy here that that has been employed, or not even long futures. You could be long the cash too. to have some protection on in this market. So I think there's plenty of room between now and 6:30 to 7:40 to, if you're short calls from up there, to get long futures. Start to go above $7. That's a great place to think about it to offset a short call. And then of course, any kind of puts you can afford and get nice and tight to the market up here around from the 650 to 660 area just make a lot of sense to me. To get a a trade or strategy going that can help manage risk. Just looking at some of those levels real quick. December options only have 50 days left, but okay, at the next 50 days, if we drop down to $6 or head significantly lower, if we want protection on 650 puts, just putting this out there, they're going for 14 cents here today. Well, if we wanted to pay for that put by selling a call, you don't have to go that high. And actually, we could be selling this $7.705 call for bringing in about the same and having an even money spread, a 50-cent wide window on the market. And of course, there's a limited risk if you sell a 710 call. Right, if we go above 710, you're short a future from there, and in theory it's unlimited risk because the market could go to infinity. But the idea though is that if you are in a 610 call or short a 610 call, and you put a buy stop above $7 in the futures, if we do break out, you've got 10 cents there to potentially protect yourself, and the 10-cent difference between those two make up for half of the cost, or the majority of the cost, I should say, of the put. And by the way, you would be taking in that 13 cents for 14 cents for having sold the call as well. But anyway, it's just an idea for a risk reversal type strategy that if we do start to turn over, there's ways of capturing that here. Finite risk though, 650 puts going for that 14 cents. Look a little lower here. Don't have to go that far. You could be selling a 605 for 4. You're cutting down. You're taking 10 cents for a 10-cent cost. All of a sudden, you've got a 50-cent put spread that for the next 50 days, we go down to $6. Hits a winner for you. So kind of eyeing that as well as a way of being, I don't know, bearish corn. Can you believe it? We're like hanging out at highs, and here I am wanting to sell it. But the truth is the market has had every opportunity to break out, and it's just not. And now that beans and wheat are rolling over, has this trader a little concerned. But I do think we are trying to form lows, and I think some form of a low potentially could be in place for corn. I'm just not so certain. We couldn't see 50, 70 cents lower before a bottom really takes hold. Okay, so let's take a look now at, sorry, I brought up those option pricing, and I should have made them on the big window here. Nevertheless, we've got the November beans trading 13.58 here into the end of the day. Finally, kind of breaking down below that 1370 to 1360 area on the chart. We're coming back down to fill an open gap that we've had down here at 1349 to 1346 for a while now. Going back to the end of July, arguably you could make a case for that gap filled here today. So any follow through lower definitely calls into question and potentially brings up the issue of a going below $13 here, big 3 legs down, and retesting the lows from the summer. On the 4-hour chart, we have been tracking this sideways price action that the soybeans have been forming for the last several months. Talked about during the corn there, this double break of 6-1/8 lines, right? The 50% short off the highs for corn or beans of a 1471, traded back in July. Market then pulled back when it did. It traded down into the 1338 to 1365 area, broke that 6-1/8 line. Double break. We started drawing up trend lines against highs and lows, looking for that sideways or wedge structure to form. It certainly was forming as a contracting wedge and now is starting to expand. And if that range expansion here dips below 1350 in the near term and we continue this leg lower, beans could head a lot lower. Now, the other side of this coin is, well, what if beans want to reverse from here and head higher? That's great. There's still a lot to chew through, and we need to at least take into consideration what the trend is doing on its way down. So the last in the series, 50% short here, was from, and this is just in the short-term trend lower. There's a whole series of 50% that we can track all the way down and where we got to 1393, but that's not for today. Today is just to see that we traded from the 50% short from 1425 down to 1361. Traded today at highs at 1393 and all the way down to its down to the negative 23% targets and to fill that open gap. So next in the series here would be a 50% from that 1395 high down to the 1350 lows. Look for resistance into 1372 to 1380. Certainly that's some form of a trend line through the lows that we had been holding before. Had a fake head break of, and now I've come back down to test back below. Cautious that the market's really gunning up for continuation lower. Now again, resistance on the way back up. We get back above that 1393 area. 1430 is going to be an interesting level. There's a couple of prior highs, and it's also a big 50% of this last leg down. So big question though is, okay, if beans really do take a dive, how far down can they go? Well, equal legs from our 1584 high down to the 1288 low. Extend that here from the 1507 high. 1212 is the downside, equal legs. Not exactly going to go out on a limb here and say we're going that far down, but it certainly needs to be considered as possible. I've talked with a lot of traders over the last couple of weeks, high inflationary pressures, what they're seeing in the fields. A lot of these things are skewing perspective, skewing a non-biased, objective perspective of the markets. I've heard a lot of people recently saying, even clients saying that the S&P, it can't go up. It's crazy. It won't go up. This won't happen. That won't happen. Absolutes are not in the vocabulary of a trader. A trader should never say always, never, or words that don't have any kind of alternative, right? Because it's just not realistic. We have to come into the trade every single day expecting anything and everything to happen, so that we're not surprised when things like this sell-off in the beans took a lot of traders by kind of surprise, because in the weakness in corn. And when I say weakness in corn, people wondering why we're not at $7 and $8, right? Well, there's a lot of things that happen. I've got traders who are hell-bent on the S&P going lower right now. Definitely agree we're in a bear trend and it should continue lower, but the short covering rally we've seen for the last 48 hours of over 200 points, many of them, if you had asked them on Friday, many traders, if you had asked you on Thursday or Friday of last week before that rally happened, if it could happen, they would tell you absolutely not. There's no way, not in this environment, right? Crude selling off on OPEC announcements doesn't make sense. Absolutely can't happen. Well, guess what? It does, right? But all that being said, there's a clear downtrend in the very near term, and until we start breaking above 1380 or really 14, back above that $14 mark, you got to be thinking about the downside and being protective here for the beans. Beans are a little harder now to get a good downside protective strategy on. It's almost a hop in on this trend train and get short with everybody else. The corn still is at levels where we can sell calls to buy puts, be fancy with it. But we're so far away from where calls that I would want to sell that I feel like are safe, because there's no reason beans couldn't squeeze back up to 14.20 and then roll back over. But my point being is that it's going to be a little bit tougher to chase the soybeans to the downside. But that doesn't mean we can't at this point, right? So let's bring up that daily chart one more time. Take a look at the beans, and I actually want to put together a put strategy now. We're going to be looking at a put spread here, and it's going to be quite aggressive one, I think. because there isn't that much time left on the clock for our option markets. Less than 15 days. That's right, on November. 15 days. That's fine. I mean, honestly, the 1350 put for 22 cents doesn't seem terrible, but not for 15 days. Yeah, I take that everything back. So 1350 put for 22 cents. That's all fine and good. It's amazing. Could only really bring in 7 cents for that $13, meaning, you're still 14 cents out of pocket for a 50-cent wide spread here to the downside. Interesting, isn't it? Interesting. So that leads me to believe that in the soybeans, this is what I would prefer to do is, as a trader, I would actually, and this is cool because I haven't actually created this strategy or this trade idea out yet, right? Like this is happening in real time of something I would be interested in wanting to do. I'm going to look for these Friday weekly options. They go off in a week, so a week from tomorrow. I think that's all the time we need, and I don't think soybeans are going to rally all through next week. And if they do, I don't want to be a part of the market. And this is how I'm going to, guarantee that for myself. My line in the sand here is around 1370 to 1380. So either of these strikes for 14 or 11 cents kind of makes sense to me. I would pay, 14 cents for the 1370 call. And the reason I'm looking at calls here is because I want to sell future, buy a call to have it as my stop. But we're going to go with the 1380 for 11 cents here. Um, mm, no, I would go with the 1370, and here's why. Mental math in your head. If you're selling a future right here, let's just say you're short 1360, right? That 11 cents spent on a 1380 call puts you at 30 cents of total risk. Why? You're short from 1360. Your stop's effectively at 1380 at that strike price. That's going to be 20 cents of losses if we go up there. But you're also paid 11 cents. So now you're at 30 cents of losses. I don't hate that idea because I wouldn't want to sell a future here and have a 30-cent stop at 1390. I would actually be fearful of 1390s being able to trade again. And if we did get up there, I might actually think about selling the market and getting short. But for 14 cents, you can do for 14 cents, yeah, you can do the 1370 call, right? That's only 10 cents away from the market at a 14-cent cost. So now for 24 cents, we just lowered that cost by a few pennies. You can have a more aggressive strike price at 1370. It's a little lower as a stop. Now, I wouldn't necessarily be looking to sell right here at 1360 in the overnight session. Let's flip over, but I am going to be looking to use that 14 or that 70 call for next week. Goes off next week as a potential stop, on a short futures position for soybeans. And this is where I'd probably, I'm looking to sell intraday. Let's go down to a 15-minute chart here. Intraday, the next in the series 50% short should come in around 1372, but just within today's price action, 50% of today comes in around this 1365 area. So being a seller somewhere between 1365 to 1370 here in the overnight, using a 1370 put, trying to get it for 14 cents. If it goes up a little bit, it goes up a little bit in cost. But even if you're just a seller at the open and it gets filled right around here with that, and we're able to pick up a 1370 call for 14 cents, we know that for less than 25 cents, you could get into a short in the beans. It's going to take some margin to hold, and certainly if the market goes against you, that margin might increase, but your net loss can never increase because you're long a call, short a future. You're in a covered. It's not a covered, but it's a synthetic put. Now, okay, so if we're spending 24 cents out of pocket, you got to go and look at, okay, what are some options that maybe we could afford that would give us similar exposure. You could spend a couple pennies less and buy the 1360 puts for 21 cents. But the difference here is that you're going to make half of what you could potentially make if you went with my future strategy, right? So the at the money put's going for 21 cents here for a week out. I would prefer to sell a future, buy the strike that's 10 cents above my short future for 14 cents, having a net cost of 24 cents if I'm wrong, versus spending 21 cents on a put that is just binary. It's just I'm right or wrong. There's no way of working out of that. There's no way of managing that position and feeling comfortable with it. And the reason being is because you have to be right, right? And the worst part about it is the delta on the position at this time. The delta on that is only going to be a 0.5 delta. So that means that for every penny we go up or down, you're going to be making or losing only half a penny. Whereas the delta on the other strategy of selling a future, being long a call, your net delta is going to be only slightly higher at like 0.6, maybe 0.65. But every penny we go lower, once you recuperate that 14-cent cost from buying the call, is 1-to-1 now. Now you're getting full. Now you're getting full market, the full market value of your futures position. So all with the same risk at the end of the day, if that makes sense. So again, we just kind of highlighted and went over, okay, do I buy a put here, to try to get short beans? Do I sell a future and put a stop in the market to try to be short beans and risk being ticked out 25 to 30 cents higher? Or do I sell a future and buy a call as a synthetic option? And lo and behold, buying a future and selling a future and buying a call, creating a synthetic put actually ends up being a slightly better, in my opinion, risk profile and trade profile than just buying the put outright. So we'll see how that plays out here in the near term. But again, still, while I don't love just chasing the market lower here, because I think we do run the risk of getting a little bit of a bounce. The market is still in a downtrend, and I'm still a little bit more bearish to the beans than maybe I ought to be right now. But we have been heading lower in the near term. All right, so last but not least here today, let's take a look at that wheat chart. I do want to actually first look at the protein spread here. Chicago or KC Chicago wheat spread. We've been looking at this one for a while. Very much sideways in a range. We're up into the higher end of that range that we've been in for the last several months. We're now starting to maybe break out of this consolidation that we had been in. So I'm looking, pullbacks towards 80, possibly as support. But if we were to fall all the way back down, or collapse a little lower, I'm a buyer, certainly down into the low 70s, high 60s. But in the near term, 80, broken resistance now is support type of level. Certainly want to stay above our last strongest day's low here around 75, to keep the progression, in my opinion, of this little trend kind of higher. But we may not see that, we might be heading to $1 to $1.20 before it pulls back over. But needless to say, if you were a part of this and you were rocking bull spreading here in the KC Chicago with us, certainly be happy with gains if you've got them. There's nothing wrong with hanging on for another push towards 100 to 120. I'm always going to keep a little something on for maybe that move. But at this point in time, anytime a spread makes new highs, I always like to think about taking profits and getting back in, just being safe. But nevertheless, it's gone up into a resistance area that I'm a little cautious about, and is not a terrible place to maybe take some gains. Chicago wheat here on the daily time frame, and we will be probably wrapping up very soon. Here, Chicago wheat finally gets a push up into its 200-day moving average around 916. Tried to break above the 100-day. 18-day moving average is where support came in today, but we did close below that level. So watch out, look out below. 55-day moving average might be where we're going to be heading down to next in this 834 area. And the full 50% retracement, which we'll look at here in a minute, might be the supportive area that we want to look for on this chart at this time. Very similar look to, KC, what have you. I think you all know my stance that if you're buying wheat, buy KC. If you're selling wheat, sell Chicago. Based off of that premium chart, the premium spread we just looked at. But as of right now, we got upward sloping trend lines in Chicago wheat here around 873. We've got potential support down around 850. That's a full 50% retracement from lows to highs. It's a little off there, but you guys get the picture. It's at 844, it looks like. That's also the old highs here from the month of August here up into 850. Very, very potential, or very likely area that if we had a little lower, could be supportive. But I'm cautious because this has not been the most constructive or the cleanest looking uptrend. It's been constructive. And I am worried now that, hey, if everything's taking, rolling over, what would stop wheat at this time? The KC chart looks a little bit better, but not a ton. It's still very choppy, still very, very overlapping on the way up here, which is why I almost welcome a big flush out down to $9 before finding the low and then really, starting a trend higher. Testing that 200-day and 18-day or 100-day moving average up there. The 18-day moving average, however, on KC wheat still holding here at lows of the day, which again, keeping it relatively, in my opinion, better bid than that Chicago. We'll continue to watch for the development there. Again, though, below this 18-day moving average, I think we open the door for 50 to 60 cents lower, where maybe I would be, then thinking about, being a buyer in the wheat at that point. So. All right, well, that wraps up today's Strategy of the Week webinar. I hope you guys all enjoyed this presentation. We went over a little bit today. And, always got to keep an open mind to things in this type of volatility because, believe you me, anything that can and will happen or could happen can and will happen, right? You got to take Murphy's Law and hold it close to the chest when trading. So thanks for joining me today, everybody. This has been a wrap on the Strategy of the Week webinar for October 6th, 2022. I'm Dan Hussey with Zaner Ag Hedge. You can always reach me over here at Zaner at 312-277-0110. I hope you guys all have a great weekend. Find me on Twitter, shoot me a message on Facebook, or email me, dhussey@zaner.com. Always looking forward to the conversations we have with you guys. And, of course, it's never too late to look into using futures trading to help manage your risk if you're a commodities producer or otherwise. Have a great day, everybody, and we'll be back with you as price action develops. Take care, everyone.